with our clients for several years. Christy, can you hear me? She is still having problems getting on. Anyway, she's been fabulous. So she's got some great information that she can share with us today. Hi, Christy.
Oh, can you finally see me and hear me?
I can finally see you. Thank you. You're there.
Wow. Good morning, everyone. Sorry about that. There was a lot of security on my end to get through for Zoom.
Okay. We're so glad that you're here. So yeah, I just started talking without you, but basically what I was saying is that we have been working with you for a while, and all of our clients that have worked with you really love you because you have tons of experience, like 34 years of experience. How long is that? 34 years. Why don't you just tell us a little bit about yourself,
Sure.
Christy?
Yeah. So 34 years of experience in banking and finance. I started while I was in college working for a bank, and stuck with it. After I graduated, decided that I did not care for working in the advertising industry, which is what my major was in. But I did like working in finance. So I moved up to Bellingham and moved along to different roles at the bank pretty quickly. Started working in loans nearly immediately after graduation. So this is like 32 years ago. And then worked in mortgages for clients most of that time, not all of that time. Bank of America back then had a really cool program called Premier Banking, and they put you through a lot of training on working with high net worth clients with really complicated financials, and gave them a really high level of service. And I did that for about 18, 19 years. So that included helping advise them on their investments, their regular everyday banking needs, in addition to their mortgage and any other consumer lending needs. And so that's when I started with mortgage. And then once I left there, I decided that the mortgage part was my favorite part. And I went to a company where I kind of let go of the rest and just started doing mortgages. And that was about 17 years ago. So maybe I might have that number wrong. Maybe that's 15 years ago that I've just been doing mortgages. And we've been doing them pretty much ever since then, the way we do them now, with the complications that have been added with documentation and requirements, things like that.
You have seen a lot of changes in the mortgage industry.
Yes, ma'am.
Yes.
For better or for worse.
One more question about yourself before we go into this is just, what is your approach with clients? How do you typically like to work with clients? I know you worked with clients of all income levels, and all different, different situations, because everyone's unique. But what's your typical approach?
Yeah, so the main part of my approach would be uncovering their short-term and their long-term goals to make sure that I'm giving them the best advice possible. And that's important because some clients are really just going to be buying their primary home and that's it. But some are looking for growing their real estate portfolio over the long term. And also some just need some advice of how to prepare for a mortgage. So I start with a consultative approach by learning everything I can about their overall financial picture, how they approach things, what their risk tolerance is, and really try to get to know as quick as I can, because you can wear clients out with too many questions, but to get to know really what their goals are. And then once I can uncover what their financials look like and what their goals are, then it's pretty obvious which loan product that we would really head towards to meet their needs. And then my goal is to basically position myself as a trusted advisor for them so that maybe I can become their first point of contact when they have a financial need coming up in the future.
So is that typically your first contact with them? Is it typically in person? Is it online?
I let the clients drive the boat on that. Everybody's very busy, and they can choose whether they'd like to meet in person, have a Zoom or a Teams meeting. They can choose if they'd like to apply verbally over the phone. The most efficient approach that I find to be really helpful to clients is I get a quick rundown of their finances, and then I send them an email with the online link with a quick condensed version of the documents we would likely need to move forward for a solid pre-approval. And then the reason I prefer that is because if they fill out the online application, then they can quickly get through all the authorizations that are required for all the rules that I have to follow with regulations and compliance. And then that's easier for them than doing, say, a verbal application and then sending them manually all the authorizations. But if a client doesn't want to start that way, they don't have to. That's just it's just a little more efficient. And then once they upload their documents, I can do an analysis, figure out which way to steer them, and then have a really productive conversation about best products to suit their needs, pricing, and any pricing strategies that we can put in place to make things more convenient and save them some money and really get the highest purchasing power that they either want or I can get for them.
Okay, today what you're going to do is you're going to walk us through basically kind of like if somebody was getting a loan for a typical medium priced house in Bellingham. So that's what we're going to do today. You're also going to take us through the different types of loans that are out there because not everybody is aware of different loans that you can have. We're going to talk, you're going to talk about rates and how that it applies to how it's different for different people and why it's different for different people. And then the different kinds of loan products too that that you might have, fees, what it costs for loans. I know that you do all kinds of different loans, right? You do conventional loan, of course, FHA, VA, reverse mortgage you even do, don't you? Is that right?
That is correct. Yeah.
Yeah. So why don't we just start with this? I am a client and I want to loan. I'm not sure what kind of a loan I want. I don't know what's best for me. And I filled out the online thing. Let's say that. I was told by my realtor to get in touch with you. So I filled out the online thing and I have 100,000 down. I am going to my house that I'm looking to buy is around 750,000. What do I need to know?
Well, that is a lot. It's a lot. So I think that I'm going to, how am I going to approach that? So if we already have the application on hand, then we would schedule at that point either an in-person or a phone call to follow up with any questions I have. Many times when clients fill out the loan application, I still have a few lingering questions. It's usually not very many. And hopefully I have the financials, meaning tax returns. And so I've been able to do any analysis of that that's required for the client. So assuming based on where you're saying you're at, I've already pretty much had the pre-approval set up. So what I would then tell the client is congratulations, good job. And you're prepared and you're ready to buy. Here is a kind of a blanket pre-approval letter that they could use if they wanted, but I explained to them how we normally like to adjust that with the actual address and the purchase price for the property that they're making the offer on. I think in our market, generally speaking, we like those offer letters to match the offer. And so then I let them know, my availability to make that happen. The other thing I talked to them about at that point would be about how we can fine tune and strengthen the pre-approval so that we can put our best foot forward when making the offer and compete if necessary. Talk to them about how I can benefit them in talking to the selling realtor if we're in any kind of competition for that property. And that's going to be if I have a full file with all the financials I've requested and reviewed them carefully and done an automated underwriting and everything looks really good, then I can really go to bat for them that this file is basically just as strong as a cash offer, I guess is how I would present it, because there's no question about the financing. In addition to that,
let me just stop you here. So typically how long a process am I looking at? Once I I filled out the application online to you, and like how long does it take typically from the beginning when I called you to closing typically?
Oh, the whole lending process from start to
Yeah,
finish?
yeah.
I mean, if you once you get an accepted offer, we just meet whatever timeframes you request on your sale. A nice smooth closing is about 30 days from mutual acceptance. That is a really comfortable amount of time for everybody involved in the process because there is a lot of hands, a surprising amount of hands in the cookie jar. So that is a comfortable time frame for the clients to be able to perform their part, myself, my staff, your staff, everybody, the escrow and title company, the companies involved. So 30 days is nice. We can close much faster if necessary. So if a client needs to close fast to win a deal or just for their own personal reasons, if it's necessary, we can do that. Legally, we can close as fast as 10 days. That's tough. That's real tough on everybody involved.
Oh, I
And
can
then you have to pay
imagine.
some extra fees for that. So I'd say right now for me, anything more than 21 days is is pretty darn comfortable to get done if everybody is kind of on it and paying attention.
Okay,
Um,
I'm just going to tell
but
everybody, the audience here too, is that I went to Christy for a loan. I was needed a loan for a home equity line of credit. And that's not something that Christy does. She referred me to go to the credit union, which I really appreciate. So if she doesn't have your kind of loan, then she'll refer you, tell you where to go. But I do want to tell everybody, doing a home equity line of credit, and you can talk about this maybe later.
Mhm.
It's 2 months into it. I still have not been approved. I am still waiting. So a home equity line of credit is getting money out of your house. And uh, you know, anyway, so there's a lot to that. I have a little more complicated situation because I am self-employed and I have investment properties, but still 2 months and I'm still waiting from the credit union is a lot. I know talking to you yesterday, you were like, ah. So what kinds of loans would you be offering other people? And yeah, and what kinds of loans would you be telling other people that maybe I'll refer you out to somebody else?
Sure. So first of all, over my tenure doing loans, I have pretty much touched any type of loan out there. So I can always be a first point of contact for questions and ideas of who to go to for that. And I'm talking about anything from, like you said, a home equity loan all the way to a commercial loan. I've had some experience with it. I myself right now am offering residential lending. So I do purchase, I do refinance for any occupancy. Occupancy is if it's a primary home where you live, or if it's a secondary home, which is considered a vacation home, or if it's an investment property. Those are the occupancy types. And then I can do a 1 to 4 unit. So once it's over 4 units on one parcel, it's considered a commercial loan.
Right.
And so apartment buildings, there is a handful, I think, of sixplexes around here. Those are all going to be commercial lenders. And those are people I can put you in touch with as well. I don't hear about a ton of those going on. Usually the people that are doing those bigger deals have longtime commercial lenders.
Yeah.
But 1 to 4 unit, any occupancy. I myself have a lot of experience with investment properties as well as structuring, setting up deals for clients with multiple properties with multiple units. So those deals are pretty hard. I was thinking about what you were saying about your home equity, and I mean, one piece of advice I have when you're searching for a lender is to make sure that lender has a sense of urgency because when we're
Mine
dealing,
doesn't.
yeah, that's what I was thinking about. Like consumer lenders in general don't have that sense of urgency, and they're not available on weekends and evenings if something becomes urgent. And in our market, I have to be responsive to you when you need it because there's no deal if we don't get our hands on that house that is our client's dream house.
So does that mean that
So
you do work on weekends?
I do some work on weekends. Yeah, I think
Okay.
one of the questions that I think you had earlier not wasn't just about how long the process is, but maybe how long it takes to actually get a pre-approval done as well. I think it was
Yeah.
kind of a two-part question.
Yep.
And I was going to mention that getting the pre-approval, a quality pre-approval is really a lot driven by the borrower and how responsive they are and how effective they are at getting documents in. So my advice on that front would be really thorough with getting your documents in. Lending is very specific. There's no guessing. There's no allowances for assuming anything. So we have to prove every number that we put into a loan file. We have to prove with a piece of paper and it has to be exactly the kind of paper that the underwriter can accept. So I would just give advice to get the documents in, be precise, and then you will have a quality pre-approval, and you're not going to hear about any, horror story of getting all the way through the process and then ending up in a declination out of the blue that you weren't expecting. But being real thorough and not assuming that, oh, they don't really need that, or I answered the question right. We interpret the forms a certain way, and not every client interprets it the same way. I mean, they're right because they're interpreting for their reasons, but we're following certain guidelines. So get your documents in. If it's a basic file and I get everything in, I could literally get a pre-approval done in about 45 minutes from when I can get my hands on it. If it's a detailed file, like you were saying yours would be, say with a business and with rental properties and even with multiple rental properties, those take quite a bit longer. There's some really extensive cash flows that have to be done. Having a loan officer that can do those cash flows is great. There's a lot of loan officers out there that don't. They hand them to somebody else to do so that they're answering their phone. But making sure having a loan officer that understands complicated financials, if you have them, is a huge benefit to you. So those can take longer because it takes longer for the clients to gather the documents. And then you have to touch the file.
Yeah. In my case, whatever documents they needed, they got that day.
That day, yeah.
So I think that you're right. Probably they don't, not many people understand the cash flow thing. So it's taken longer.
Yeah. Yeah.
Okay,
Sense of urgency.
Let's talk about kind of loans that now,
okay.
And you do VA loans, you do FHA.
Absolutely.
Why don't you take us through the different types of loans that you do?
Okay. So for the main mortgage that I do, we deal with different agencies that drive these types of loans. Within those loans, there's also different loan products. Okay. So we've got a conventional lending, which is basically what we all strive to get. Although that gets complicated because they're not always the least expensive. So there is a little bit of a misnomer out there, but so conventional is going to be your standard basic that most lenders can do. You can put as low as 3% down on those, and you can put as much down as you want. The best kind of the sweet spot for a conventional loan as far as pricing and ease of underwriting is going to be a 25% down or more. And if it's an investment property, then you even get a little bit of a win at 30% down. And then so on down the line, if you have 40%.
Will you talk about why that is for a conventional 25% and opposed to 20%, which was the standard?
Sure.
For, for home mortgage?
Yeah, that's a really good question. There's some things that people don't realize as far as how loans are priced. The main agencies have what are called loan level pricing adjustments. Basically, what that means is loans are priced based on risk and how the lenders evaluate risk. So there's some really smart people out there that run all these actuary tables. Probably that's not the right word, but whatever, they analyze it for risk, and they've decided where they're going to set their pricing to give us the best prices. So basically, on a conventional loan, if you put less than 20% down, you have what's called mortgage insurance, personal mortgage insurance. And you can pay that monthly, you can pay that one time up front, or you can pay a split between the two. Most people choose to pay it monthly because we're assuming that at some point it's going to be removed.
Will you discuss what mortgage insurance really is?
Mortgage insurance.
I don't think everybody knows that.
Mortgage insurance is a fee that we pay to a separate insurance company to back the mortgage for any mortgage that the lenders are feeling is not enough equity to protect them basically in a foreclosure. So that's a 20% down is where they've set that at. So when clients are paying that mortgage insurance, that's also priced based on risk, and the cost of the mortgage insurance goes up based on the lower down payment or goes down based on a higher down payment. So in other words, at 3% down is going to be your highest cost mortgage insurance, and then 5%, 10%, and then 15% are the other triggers for cost savings. Don't expect anybody to remember any of this. The idea is that it's risk-based pricing. So
can I ask and interrupt you too? If somebody puts a lower amount down, like 3% or 5%, yes, it affects their mortgage insurance, but would it affect their rate?
Yes, ma'am. So that's so complicated. So the mortgage insurance, when you need it, the different categories also affects your rate. Although the surprising thing, and I think what we're trying to get to, is that if you put 20% down, your interest rate is higher than if you put 15% down, or if you put 25% down. And that is what a lot of people don't realize. So if you're kind of toying with the idea of putting 17, 18, 19% down, anything above 15%, or anything around the 15% mark versus 20, and you get in your head, well, I just don't want mortgage insurance. I'm not going to buy right now because I need to save that 20%. Well, the mortgage insurance for that level is very, very inexpensive. And the interest rate is a little bit lower than the 20% down anyway. And if we do the comparison, there's a really good chance that it is the same monthly cost. And then the mortgage insurance will actually go away, where the rate would stick forever. So you definitely want to talk to your loan officer if you're teetering on whether or not you're going to have mortgage insurance. Is there other benefits to maybe hold back some of that cash?
Okay.
There's maybe
That's
other things
really
you could
important
do
for people to understand that.
Yeah.
That it's just not a set thing. You know, so many people come into understanding that they have to have 20% down, which is completely not true. That, you know, you can get a conventional loan for 3% down. That's amazing.
Yeah.
Okay.
And it's certainly not the end of the world to pay mortgage insurance. It may or may not be more expensive. So it's definitely something you want to seek out some research on.
Okay, so continue on with the different types of loans and how much they would be putting down.
So yeah, the conventional is we kind of talked about, that's the plain vanilla. It doesn't have a lot of grace for lower credit scores. It gets very expensive with lower credit scores. And it also has a pretty steadfast debt to income ratio requirement that is either going to be 45% or 50%. I don't know if you want me to get into explaining debt to income right now, because that's just a whole nother rabbit trail, but so
let's come back to it if we have time.
Okay, that sounds good. Then also we have FHA. So FHA is going to be a minimum of 3.5% down. There is a fee that FHA charges per month of 0.55%, which is just like a mortgage insurance. And then the bummer with FHA is they charge a 1.75% fee upfront, but it is financed into the loan, so the client's not going to have to pay that. But the win with FHA is the interest rates are lower, and the mortgage insurance is a set amount no matter what your credit score is. So you're not going to be dinged on your mortgage insurance like you would on conventional. So for instance, let's say you have a 650 credit, and you're putting 5% down, your mortgage insurance is going to be really pricey. I don't have that in front of me right now, but I'm thinking it's going to be over 1% per year. Where FHA, you're just paying the flat rate of 0.55. So you're already saving money. And because FHA is a government program, the rates are a little more, they're a little more forgiving as well. Depends on the day, depends on the client's credit score and a couple other things. But I want to say the interest rate difference can be also another 1%. So if you have someone who's teetering on credit score and who's teetering on debt to income ratio, FHA is a fantastic way to get a buyer in a house that maybe doesn't perceive themselves as a borrower. They might be a great borrower, and it's just your first step to get there. There's nothing wrong with an FHA loan. So if anybody is telling you, oh, you don't want that program, they're not seeing it from the full view.
It's very individual.
Yep. And then we have VA loans, which are only for vets. That is a fantastic program. It's probably my favorite loan, just because the interest rates are very forgiving as well, similar to FHA. Debt to income ratio is also very forgiving. They're a little bit stricter on the appraisal, but that's just because they're putting clients in a house with zero down, and they want to make sure those clients have a livable, safe house. So it's a good reason behind it. And they don't have mortgage insurance. Now, they may have a VA funding fee depending on their particular situation, but they may not. I would say more often I see veterans getting into these loans that don't have to pay that funding fee. With also, just side note, since we might be entering into a decreasing rate environment, say in the next year or so, the VA and the FHA loans have really nice streamlined refinance programs out there that are very easy to deal with and low cost.
Okay.
Okay, so USDA is another program that's rural housing that is for areas out in the county. So it's specific to an address, and it also has an income maximum. So very few borrowers qualify for USDA because of the income cap, and also because they have a pretty stringent debt to income ratio. And because we have expensive houses, our clients that are buying a lot of those houses that would want a USDA loan are going to have a debt to income ratio that's probably a little bit higher. They want to keep it at 42% or lower.
What's the income
so
cap?
Occasionally, that is a great question. I don't have it memorized. It depends on how many people are in the household, and there's 3 different categories. It's going to be a little over 100,000, say, for a family of 4.
No,
up recently
isn't
too.
it different
I'm sorry, I don't
for
have it
different
memorized.
counties?
I used to, because we used to use it all the time.
Yeah. So
Yes,
it's not like one set
yes,
thing.
it's a little more for
Yeah.
Whatcom than Skagit, and a little less. Whatcom's a little
Yeah.
less than Snohomish and King.
Okay.
Pierce.
Okay.
Yeah, absolutely. So it could be that if I have a client that says, can't do USDA in Whatcom, they could do it in Snohomish. And so we keep an eye on that, depending on where they're buying. It's a fantastic program. It's just, we're just not able to utilize it very much, but really great. One of the reasons it's great is the mortgage insurance is also lower than even FHA and locked in. And it's not mortgage insurance, it's called the annual fee, but it's the same idea. And the rates are lower, so that's nice. And then we have the down payment assistant programs through Washington State Finance Commission. That income cap is higher, and that is a fabulous program as well for someone that doesn't want to or can't save the down payment to get them into their house. But their interest rates are higher, so they do lose some purchasing power with the higher interest rate. But I would say there's still several clients a year that's how we get them into their first house, and very pleased with that program.
What is the minimum they put down?
In all these programs, the down payment assistance program is a 0 down, and and I can also come up with a little bit of money towards their closing cost, and generally we'll ask the seller to pay the rest of the closing costs.
Okay.
So they can get in. They could get in with 0 if we can get a seller to accept that offer.
The other side of that, though, is the interest rate's probably a little higher, I'm guessing.
Yes, ma'am. So that means that they buy a little less house if they're maxing out their debt to income ratio than they could say with just a straight FHA program.
Yeah. So VA is the rate's not higher. Is that the only loan where the rate's not higher, VA and conventional, because of
VA and FHA and USDA, they all 3 have similar interest rates, and they're lower than conventional.
Okay. VA, FHA.
The thing with those programs is first of all, if you can get a VA loan, then that's what you're going to do for sure. If you can get a USDA loan and you need 0 or close to 0 down, and you can't do VA, but if you can get it, then that's what you're going to do. If the only way you're going to qualify with your credit score and your debt to income ratio and your limited down payment, then you're going to do FHA. I mean, really what drives these choices is going to be your financial picture on paper. So how much you have down, what your credit score is, what your debt to income ratio is, any previous derogatory credit history that factors in, it's really going to drive us to the right product. And then within those programs, then we pick loan products within those. So that would be, an ARM versus a 30-year versus a 15-year. When we were refinancing a lot of loans, I had clients do 25-year, 20-year, 10 years. They picked some not as popular terms because they could, because they didn't want to string out their loan.
With the ARM, why don't you talk about that a little bit? Because right now everybody's thinking we have high interest rates and we're hoping they're going to come down. So what are your feelings about ARMs, and tell us a little bit about how they work?
So I like ARMs. I think they're great for the right borrower. What I've found is the lenders
Tell
that
people
are
what they stand for.
adjustable rate mortgage. And basically what happens is you enter that loan with a fixed rate for a certain amount of years. And after those years end, then it turns into an adjustable. I would say a common one right now would be a 7-year. So you go into it where you're fixed for the first 7 years. And then if you still have that loan at the end of the 7 years, because there's no prepayment penalties on any of the loans I sell, period. So yeah, that's really important. A lot of people ask that question. Then at the end of the 7 years, it'll start adjusting every 6 months. That's probably, I would say, the one that most people would pick. But right now, the rates really aren't any better than the 30-year fixed with the lenders, at least that I work with.
Really?
Yeah. Occasionally you'll see like a portfolio lender, you've probably all had this, will come on board and they'll say, I have this great ARM product. It's really, really low. And then it basically beats everybody in town. That's just because they have a certain pool of money that they've got to move and they've got to get into loans right then. And then it kind of goes away. And so those types of one-off products where they're a really good deal are going to come and go. I haven't seen one around town for a long time, but that will happen. And right now, most of the lenders are just a lot more comfortable with these 30-year fix. And I don't know exactly why, because I feel like they have some room to price ARMs effectively. But I'm just not seeing those out there. So I like them. I think they're great for the right client. A client that has a short-term lending need, if they're actually winning on rate, which that's the problem right now. They're not really winning on rate, but they're expecting a windfall. They're only going to live there a short period of time. There's different tools we use to talk to the clients to see if an ARM is even a potential need. But those are the main ones. It's a short-term need, or they're expecting a windfall, or they're going to be moving soon and selling.
Would you talk about, so we haven't talked about yet, manufactured homes, reverse mortgages, and bridge loans.
Okay. So yeah, manufactured homes are very easy to do on purchases. They do have a little bit higher risk from the lenders that fund these loans standpoint. So a lot of sorry about that. Let's see. The couple extra things, the interest rate's a little higher because they consider them to be a little bit higher risk. And I think that's just because they consider them at a certain point to maybe depreciate.
Which they do.
Yeah. And if they have any repairs or any additions, then we have to prove that L&I has inspected those. So they have to have tags and stickers on the house proving that. So a good example, which comes up a lot, is if they put in a wood stove and they did it themselves and didn't get it approved, then they have to go back and have L&I inspect. A lot of the programs that lend on manufactured homes will require a foundation certificate from a certified HUD engineer. Heyman Associates in town's doing those for us right now. They're fantastic to work with. They cost about $400 or $500. And it's actually really nice because they go in and verify that that's been installed properly and that everything is still secured and looking great underneath the house. And that is important to the integrity of those buildings. So it's a big deal. Yeah. We also have to prove it's never been moved for probably about 90% of the loan products and the best priced loan products out there. What else? I think insurance agents are, they can be done. I can do them VA, I can do them FHA. So you can go in with a low down payment. Refinancing is a little bit stricter on the cash out refinances later for the same thing we talked about earlier, the potential depreciation aspect.
Okay, what
Oh,
about
and I only do manufactured homes on land where the title's eliminated.
right? Yeah, okay, which is typical for lenders, yeah.
It is very,
Oh,
yeah, very
yeah, that's
typical.
pretty standard. How about reverse mortgages? What are your thoughts on those? And what do people need to know about reverse mortgages? Are those a good idea or not?
Yeah. Reverse mortgages are great for the right person. That again, it's all goals driven. So it's for clients that are 65 and older. If they need to say they either A, just want to get rid of their mortgage and not have that expense, or B, pull cash out of their house for whatever they want. Usually it's for repairs or upgrades. I had one gentleman a couple years ago do it for a big trip around the world. So it's just whatever they want as long as the equity is there.
Okay, cool.
For reverse mortgages, they're very strict on making sure it's insured, making sure the house is also safe. They are usually variables, but sometimes fixed. They negatively amortize. So what that means is all the interest and any of the advances stay in the loan and don't get paid until you sell the home. That's the whole point, right? Is to not have a payment. So for a retired person who say needs extra money in retirement, does not plan to ever move, is okay using up some of their equity. It's a great way to really enhance their life. I've seen some really productive situations. My mom actually has one. She had one before I started doing them, and it kept her in her house probably an extra 20 years.
What are the cons of them?
Say that again.
What are the negative?
Yeah. So the negatives are they're expensive, and they do eat up your equity. But they do limit how much they're willing to advance. They've done a lot of research to make sure that nobody ends up negative on their home equity when these loans do get paid off. If a client needs to go out of their house for medical care, say assisted living, and they feel it's temporary and they'll get healthy and come back to their house, the reverse mortgage requires that you sell the home after 1 year of being out of the house. So I would say, the expense and eating up your equity and the fact that you are forced to sell at some point. I don't think that's unreasonable for the right person that say they don't really need that equity for anybody else. They didn't maybe save enough for retirement and they have expenses and they can tap into that equity. I mean, a lot of people have a lot of equity, so it's a really great program.
Okay. And the last loan I'm going to ask you about is bridge loan.
Bridge
I
loan.
know that not too many people are doing that, but I think a lot of people want information about that.
Absolutely.
So can you talk about that?
Bridge loans are a fantastic way to leverage the equity in your house to purchase your next house without having to sell first. And they're a little more expensive than a standard mortgage. So we reserve those for people that are going to either not have a mortgage in the end, maybe don't qualify for both mortgages at the same time, and absolutely have to sell, have to tap into their equity for their down payment on the next house. I'd say some of my favorite programs that I've seen for those are going to go to combined loan to value of about 65%, because those seem to be the most forgiving as far as not having to have so much in cash reserves and not having to worry so much about your debt to income ratio. Because a lot of people that are wanting to do bridge loans don't really have enough income to support the next loan, or at least a very big loan. And so there is programs out there that can address that for sure. There's also programs out there that can go with bridge loans that can actually lend on a contract. So for instance, I have a borrower right now that has a contract on a house they're going to sell, but because they're selling to a contractor, it's not going to close for 9 months and they want to move now. And there's a lender that will do that based on the contract being assigned to them, which is another form of bridge loan, which I think is super interesting.
Cool. Oh, that's cool.
Yeah.
Okay.
So some of those products I can do, some of them I can't, but I could probably direct you to somebody that could, if that's something you might need, that in our consultation, we decide that that's a better product for you than a standard purchase mortgage.
Okay, now I'm gonna bring you back to, I walked in, I need a loan for the house is 750, I'm putting 100 down, so it's a loan for 650. What am I
Okay.
looking at today? What kind of payment? Tell me about what it's gonna cost. What kind of, nuts and bolts of that?
Do you want to share this document I sent you, or do you want me just to run through it verbally?
Why don't you just run through it?
Okay. Okay. So for this scenario, Lori and I talked about this yesterday, and I ran it. One of the common things that I run into is I'll have a client tell me that they have a certain amount to put towards the purchase, and they call it all a down payment. But many times we have to back out the closing costs, which is not the 2, 3, 4,000 that it used to be. It's a lot more expensive for many reasons. For this particular scenario, when I worked this morning, it looks like it was going to be right just under $12,000 in just closing costs.
12,000.
And that's with
cost.
Yeah. I mean, I'm rounding that number because I don't
that's
have that.
Okay. For right now, I think that's great.
Yeah. So basically, what I did is I put $88,000 towards the down payment. And then calculated the closing costs and calculated the payment. So this payment today, this particular scenario, if the client has really good credit, the payment's going to be about $5,000. It's a lot of money.
$5,000 for a 30-year loan.
30-year fixed, and this rate was 6.875 at no
Okay.
origination fee.
6.875. Okay.
Yep.
And that's principal and interest?
It's principal and interest, property taxes, homeowners insurance, and the mortgage insurance that we talked about. So it's everything. It's all inclusive.
Okay.
You might hear the term PITI, and that means principal, interest, taxes, and insurance. And your lender might say that. You'll see it on emails. You'll see it on forms, PITI. And in this particular case, because we're only putting, what was it, about 80 or about 12% down. Let's see if it says it on here.
100,000 is what, 12% down?
Well, 88,000, right? Because we backed the closing costs out. So about 12% down. So you have $110 in mortgage insurance on this one as well. Okay. And now remember, if we would have put the 20% down, this same rate probably would have been closer to 7% instead of 6.875. Okay. So that 110 for mortgage insurance is not, it doesn't mean your payment is 110 higher.
Okay.
Basically. So that's, it's 5,050 is what I came up with. When I estimate taxes and insurance for clients in our area, I usually see insurance come in somewhere between $75 a month and a couple $100 a month, depending on the price of the property. And I think also just what they're adding, if they add anything extra. Okay. And let's see, the taxes I usually use with 80 basis points, so 0.8%. Whatcom County average is right around there. So what that means is about $800 per year in taxes for every $100,000 of market value. So that's $500 on one. 500. Okay. Yeah. Yeah. Okay. Yeah. All right. I'm going to quit asking you questions and let anybody else jump in here, because I know I've just been like blasting you with one question after another. I'm trying to get like so much information out of you to share with other people. But how about I open it up? Does anybody have some questions that they would like to ask? No? Well, maybe I asked them.
Hey, Lori, I do.
Oh, good.
How you doing?
Go ahead, Glenn. Hi.
We're looking, I've got two houses I'm going to want to sell. Looking at buying one house, but need to buy the house before I can sell the other two. I'd be eligible for the VA loan. How would we work that?
No, that's a great question. I would do the application, and then what I do is I always start with the most advantageous product and then work my way down from there. And what I consider advantageous is price is, the cheapest one first, and then the easiest one to get. So the most convenient product for you. So off the top of my head, VA might work, but we still have to meet the debt to income ratio requirements. And we would have to count any expenses with those other houses. So you have to have enough income for all 3 homes to close on a VA loan before you sell the others.
Yeah.
If you're in contract, there could potentially be some allowances. Just, if you're in contract to sell those houses and we can prove they have final approval, there might be
That's
some
what I was
allowance.
wondering. I can have the houses up for sale while we're still working on closing the house.
Are they rentals?
I live in one of them and I rent the other. Lori kind of knows what's going on.
Yeah.
Yes. So the one that you live in could definitely be for sale. Do you owe anything on either of those houses? Okay. So I think we'd have to do a financial analysis for me to best direct you. It could be that the bridge loan is better. It could be that we can do the VA loan, which would be the least expensive route.
Yeah.
VA does not allow for what's called a recast, though. I don't know. A recast is when you put a lump sum payment on an existing mortgage, and the payment can be re-amortized based on the current loan without a refinance. But that is only done on conventional loans. So that's another thing that we would probably have to talk about, having the ability to do that without having to refinance. Because with the VA loan, even if you make a big lump sum amount, they're going to continue to require that full payment.
Okay.
So my guess is that, it might be more of a bridge loan or a conventional loan, but I mean, we'd probably be refinancing in a year or so anyway. So that would just be a tolerance thing for you.
Yeah, because I'm kind of figuring there could be the possibility I'll be making 3 mortgage payments at one time there for a while.
Yeah.
That sounds
It's not one where we can. It's not one of them where we could like move out of both houses and be somewhere else until we got the other house approved and these sold.
Right. It's a lot of work. The rental, until I saw your full financial profile, I would say I would prefer that's not listed, because we would want to continue to count that rental income to offset your expense on that one.
Yeah.
And so assuming that that's going to take care of that, then we could be fine. Now, another thing we could do is look and see in your situation if VA would allow us to do a vacating. So say for some reason a bridge loan doesn't work or whatever the case may be, could you get a lease for a year on your house that you're moving out of and sell it later? And then we could count a portion of those rents since you're an experienced landlord. We might be able to work something like that out. I'd have to check. Some of the lenders have gotten stricter with that option on the government program. So I'd have to check VA guidelines to see if we can still do that. But that might be a kind of a backup plan too.
Yeah, because that's one of them. Once we sold them, whatever profits, and there would be profits, would just automatically go into the loan on the new house to help on the payoff.
Right.
Yeah.
So it's kind of short.
It's not like I'm going to pocket it. It's like, okay, it's going into the new house. Let's get the payments down even lower.
Yeah. So we'd have to look at what your current combined loan to value. Now, they would most of the bridge loans out there would only allow us to use your primary to primary. They wouldn't let us do collateral on 3 properties. So there'd have to be enough equity in the new house to basically get the combined loan to value probably below 80% on both.
Okay.
And that's where a lot of clients can't get to. And that program, you still have to debt to income qualify. If we can't debt to income qualify, then it's a qualitative approach. Everybody's situation is so different. There's not a blanket answer. But there is a lot of cool products, a lot of options that might be able to suit your needs and get you where you want to be.
Okay.
A lot more choices than we used to have. That's for sure. There's a lot of brokers that have come on the market that are offering quite a bit of choices.
Anybody else have any questions? I know we covered a lot of information. Christy, I put your telephone number on the chat here, so Glenn, you'll have that too.
Oh, thank you.
So
I have one
you can
question.
reach out, and anybody that wants to get in touch with Christy, we will, I have the telephone number here. I'll put your email also on that. And it will go out in our newsletter. Our last newsletter you were in too, so you have the information there. But
Wonderful, thank you.
yeah.
Can you hear me? I have one question.
Oh, sorry,
Hi,
Jenny.
Jenny.
Yeah. Hey, so get a lot of clients who are retired or retiring soon. How does that affect? I mean, I suppose it's like a financial analysis, like for everybody, but how does that affect your ability to buy a
No,
home?
this is a fantastic
mortgage.
question. That is a great question. I'm not on mute, am I? I took my glasses off.
No, we
I
can
can
hear
hear
you.
you.
Yeah, no, this is huge because what happens is a lot of clients say they qualify right now with their regular income and they're not retired yet, but maybe they wouldn't qualify for that as big of a loan as they need to get through the transition when they retire. And there's a couple of reasons for that. One is maybe they haven't started receiving all their retirement income yet. So it's hard for me to verify and meet the rules of the underwriting guidelines. The other is maybe they're just going to make a lot less, but it doesn't matter because they're going to, when they make their move and sell later, they're going to have a big pay down. So the mortgage is going to go down a ton. So there's a couple of ways we can go. They can get retired, get settled, have the income start being received, and then try to go through the loan process and max it out, which sometimes is a letdown for people. Or we can do the purchase ahead. If they have a way to access a down payment, we can buy it as a rental or as a vacation home. The interest rate's going to be a tiny bit higher, but not terrible. And we can qualify them based on their pre-retirement income. But the key to that is they can't give notice. They can't have a solidified retirement date because when I go to verify income, I need to know that there's no end date. Almost all the programs that we talked about have a required income thing is a wrong verbiage where it's up to the underwriter to determine that the income is likely to continue for 3 years. And there is a lot of the documentation that we do is assumed by the underwriter that documentation means that it's probably going to keep going on based on their history and based on what the income is, that it's likely going to continue if it's W-2 income. So they will make that assumption. But if all of a sudden the VOE, the verification of income, comes back and there's a note saying, oh yeah, they're great and this is what I made, which we've already verified, but they're, yay for them. Congratulations. They're retiring in 3 months or they're retiring in 6 months. Then it's completely blown out of the water. So they need to not give notice if we're going to buy the house pre-retirement until after we close, and then they can do whatever they want.
Yay. Okay.
Yeah.
Good to know. Thank you.
Yeah. And another note on that, which is interesting, is say you have retired clients already and their income is pension or Social Security. We used to have to verify 2 months receipt. We only have to verify 1 month's receipt in the award letters now. So that's really nice. So a lot of times that makes it a much smoother transition if that's what we're relying on, and they're going to get it right away. The IRA income sometimes can be tricky because a lot of people don't take it regularly, especially if they're not 70 and a half and they haven't had the required minimum distribution. So what we can do if they have enough funds in their IRAs to support it, but they're not taking from it, is we can set up a temporary draw to meet the needs of the mortgage. And then we can see it's set up systematic. There'll be a form that the broker gives us, and we can see a deposit come in. And then we can see from a 2 months history that there's plenty of assets to support that for 3 years or more, which is the 3-year rule I was talking about earlier. But then once the mortgage closes, they can stop it. They can cancel it. So it's just a temporary thing to get them rolling. Some people don't like it because then they'll have to pay taxes on it. They didn't want to pay taxes yet, but it gets them in the house. Did I lose you guys all that? Was that all too boring? I feel
No.
like I see
No,
noise.
that's great. Yeah,
We're on mute.
I'm
yeah,
such
that's
a nerd.
great.
This is fun.
Yeah. Well, anybody else? Any questions? Okay, because we are going on almost an hour now. So
Okay.
thank you, everybody, for coming. I have your corrected email address in the chat now, so not the first one, the second one. And your email or your telephone number 360-319-8659, right?
Yes, that's correct. And then the second
Yeah.
email for sure.
And the
Okay.
second email, yes. Sorry,
Perfect.
that was my mistake. Okay, Glenn, if you have more questions, get in touch with Christy. Anybody have questions? Or Glenn, any way I can help you? I am here. Yeah, thank you
No,
so
I'm
much,
sure
Christy.
I'll be getting a hold of Christy and Lori, we'll be talking to you some more.
Yeah, thank you so
Excellent.
much, Christy. Yeah, thank you, everybody.
My
Have a great day.
pleasure.
Okay.
Yeah, enjoy the
Christy.
sunshine. Bye,
Appreciate it.
everyone.
Bye. Isn't this nice?
Bye.
Bye.